Hi, I'm John Ross. It is Wednesday, January 9th. The Federal Reserve is back in the news, and the good word is patient. That's because the Fed chairman and Fed board members are making comments about how the Fed can be patient with future rate increases. Now, the market likes that, and since Christmas, we've seen a nice rebound in the stock market. But we should be patient before we jump back in. Let me show you this chart of the S&P 500 to explain why. This is the S&P 500 E-mini futures contract, and it goes back to October of last year. That's when the drop-off in stocks began. Stocks sold off sharply in October, then consolidated through November, and then another sharp drop happened in December. But since Christmas, it's been a different story. Sentiment has improved. The mood is good, and this week especially, it's tempting to want to jump back into this market. Prices are on the way up. Momentum has changed direction, and it's kind of one of those times where we don't want to miss out on the beginning of either a new bull market or a much bigger rebound from here. But we want to be careful. We want to be cautious, I think, today because this enthusiasm might need to take a break very soon. And I've marked some wave levels on here. Now, if you've followed some of my stuff, read or seen some of my videos, then you know I like to look at three-wave patterns because three-wave patterns are just indicative of the underlying human nature and market psychology that drives price action. And I think it's good to give us context. It's good to help give us price targets across various time frames because these patterns are rather predictable and exist in various time frames. So let's start with this rebound that we've seen the last 3 weeks and just kind of get an idea of how high it could go. So if I want to look at the three-wave pattern that's unfolded, I would mark this first wave and go down through the bottom of the second wave to give me a target for the third wave, for this small C wave. And a good starting point is to expect a C wave to complete 100% of an A wave. So the A wave will equal the same amount as the C wave in that scenario, which would take the S&P 500 in this case to about 2621. And that's not far from where we are now, somewhere just shy of 2600. So let's say I'm right. Let's say the S&P 500 does come into resistance very soon. And if it does, it's likely going to need to see some type of retracement and correction of this new rebound in order to sort of sustain the upside for a longer amount of time. Now, to get a sense of how far the S&P 500 could pull back from that level, we would want to use a retracement tool, and we would start from the beginning of this three-wave pattern up through where we think it will end at 2620. So we would drop that in there, and then we would look at the common retracement levels of 38%, 50%, or 61.8%. Now, again, as a starting point, I like to assume a 50% retracement as kind of a happy medium. And now that would be where we would mark a B wave. Now, say we're right about the S&P 500 topping out around 2650 or 2620, and then retracing about 50% down to 2480. If we are to see an extension of this ABC move, and we are to see a 100% extension of it, so this small ABC or this A wave equals this big C wave, then we would come back and we would use our extension levels. And we would measure this big A wave to here, come down to our B wave there, and it gives us a target of around 2750 for the big C wave or the third wave of this larger term move that would happen over the course of, say, the first quarter of this year. Waiting for the S&P 500 to pull back to somewhere around 2500 would probably be a good place to then look to get into this market and expect a move up to 2750, even 2800, just depending on how sentiment unfolds. But I wanted to give you a sense of what I'm looking at. Hopefully you can use this. Thank you for listening, and we'll talk soon.